Alright, for this video we want to go through a sample form 1120S S-Corp return for the 2023 tax year. Now in this scenario we're going to have a company that actually closed down its business and dissolved the entity during the year. So they've still got some activity to report, but we are going to be filing a final return as is marked in box H1 here. And so this is a company that was dissolved on October 31st, 2023. So we've got the full return here with the K1s, K2, K3, and we've also got the prior year return from 2022, which we'll need in order to carry over some of those beginning of the year balances. Now, in addition to that, we have the sample financial statements for our company here. So we've got a profit and loss from January 1st through the end of October. And then we've got a balance sheet as of October 31st, but it hasn't been completely zeroed out yet. So what we'll see here is we are in a position where all of the assets were liquidated and all we have is cash remaining. And that's so we can get a sense of what our liquidating distributions are going to look like. All right, so we've got those, and then lastly, just one slide here covering the background on what we're going to have in the tax return, and then some details on the fact pattern. So as far as what's going to be included here, we've got the 1120S for an entity that closed down in October. And so we need the standard pages 1 through 5 of the 1120S, and then we've also got the 1125E for officer compensation, 1125A for the cost of goods sold and the inventory reconciliation. We have a 4797 because we sold some business assets during the year, right, as part of our liquidation. And we've also got the Schedule K1s for the shareholders, and that includes the K2 and K3. Now, we do have some separately stated items, so we'll talk about these later as well. And then how do we close out the books and look at our basis worksheets and reconciliations for the shareholders. So in this tutorial here, we've got John Smith and Jane Doe open a restaurant last year. And then in September of 2023, they decided we wanted to close the business and they're going to just dissolve the entity as well. So the restaurant closed on September 30th, 2023, and then the company spent the next 30 days winding up its affairs, right? So liquidating the assets, paying down debts, and taking care of all that, all those tasks. Now, the company, as far as assets here, they bought some kitchen equipment last year for $15,900, and they took a 100% bonus depreciation last year. And so when they sell it this year, they actually managed to sell it for a little bit of a gain. They got all their money back. And so for that reason, we're going to have some ordinary depreciation recapture, and they've got some 1231 gains that will apply. Now, after selling all the assets and paying all of its debts, the company had $107,805 in cash available. And so we'll see how that amount gets recorded on the return in the K1s and how it really comprises two items, right? It's a reduction to retained earnings, so a distribution of E&P, and then there's a return of principal amount. Now, this is really important, this last bullet point on the due dates for the return. So when you file an 1120S on a calendar year, the deadline is 2.5 months following the close of the tax year. So March 15th is normally the deadline we think of. But if you have a short year return, the deadline is 2.5 months following that close of the tax year. So if we shut down and dissolve on October 31st, it means that the 1120S has got to be due on or before January 15th, right? And so for that reason, a lot of short period returns, the companies will file an extension request to give themselves another 6 months because a lot of times the forms aren't even available, right? And so rather than stress about trying to get this filed before middle Jan, they filed an extension request, and so that gives them more time. All right, so let's have a look at the return, and then we'll look at the financials and kind of work through this. So we have the 1120S here for 2023. Because this isn't a full calendar year, 2023, we've marked the short period return as January 1, 2023 through October 31st, right? So October 31st is when the entity was liquidated, so closed down at the state level. So we've got the effective date of the S selection. So all this information can carry over from the prior year. Date incorporated. In box H, we are marking it as a final year return, right? And we have 2 shareholders, so we're going to include 2 K1s with this filing. Now, before we get into the current year information, it's always good to kind of start with what gets rolled over from the prior period. So when you're looking at the Schedule L balance sheet per books, the beginning of the year numbers are balances on the Schedule L from last year at the end of the year. So if we take a look at their 2022 return and I jump through to the Schedule L, we can see here the balances at the end of the year, cash, their inventory balance, they had a security deposit of $15,000. We can see the kitchen equipment there that was fully depreciated, and then the liabilities and net equity as well. So accounts payable, capital stock, additional paid in capital, and the end of the year retained earnings. And then also we have the M2 reconciliation at the end of the year. So there's our $4,200 amount in the AAA account in column A. So all of those balances need to get rolled forward to this year. So we've got our cash from last year, the inventory, security deposit, AP, the capital stock, APIC, and then our retained earnings balance. And then in the M2 rec, we've got line 1, balance at the beginning of the year, 4209. That's carried over from the balance at the end of last year. All right, so once those are completed, we can look at the questions on Schedule B. So Schedule B, most of this, again, is going to carry over from prior year unless there's been a change. So in our case, we're accrual basis taxpayer in the restaurant business. None of these items apply as far as the company doesn't own any subsidiary entities or have any investments in partnerships. So those are all just blank. We don't have any restricted stock. We don't have any unusual kind of options or warrants. So all of these are going to be no. We're not a real property trader business, so we haven't made any of those elections. Schedule B, question 12, right? We don't have any debts that were canceled, right? So that's important, right? We are dissolving the company, but we're going to have enough cash to pay off all the debts. We did have to file some 1099, so we've marked those as yes. And then line 16, we didn't receive any kind of digital assets, no crypto in the form of payment. All right, so let's have a look at the financial statements and complete page 1 here for the ordinary income loss. So we've got the restaurant's profit and loss on the left-hand side here. So we've got their food and beverage sales, their cost of goods sold, all right, the inventory products, and then the various expenses. So all of these get keyed in to page 1 because they are ordinary business income or loss items. The items that will get separately stated are the charitable contributions, the interest income on the savings account, and then the gain or loss on the sale of equipment. That if it includes a 1231 item, that's going to be separately stated as well. So let's actually have a look at that to start because that's going to flow through. So on the fixed asset side, you can see these amounts are zeroed out because we've sold all the inventory. Our security deposit was returned to us. On the fixed asset side, the kitchen equipment was sold. And so when you sell the assets, you remove the asset from the book and you zero out the accumulated depreciation that goes along with it. And then the difference is effectively the gain or loss on the sale of equipment. So if we look at the 4797 for this, we have the 4797 split into a couple of parts. All right, so part 1, 2, and then part 3 for gain or disposition of property. So in part 3, we list the 1245 property here. So this is kitchen equipment, it's personal property. Date acquired, date sold, and here's the financial data on the sale. So the total sale price that we sold it to a third party for was $16,100. Now our original cost basis was $15,900, but we have it was fully depreciated because we claimed the bonus depreciation. So our adjusted basis here is $0. So when our adjusted basis is 0 and our gross sales proceeds are $16,100, the total gain is going to be $16,100. Now, on line 25, it's asking us for the depreciation that was allowed and taken because we have some recapture, right? So we've got $15,900 of depreciation that was claimed on the property, and so that obviously gets recaptured as just ordinary gain. So on line 30, where we have the summary of these items here, total gain for all the property, $16,100. Right, add the property columns A through D, enter here on line 13, right? So we've got $15,900 of ordinary gain that needs to be recaptured. So we'll go ahead and enter that on line 13 as they asked. So we go up here, ordinary gain or loss in part 2. Line 13 is the gain from line 31 down below. So there's our $15,900. Now, the other item, line 32, we subtract line 31 from line 30, and then we get the $200 of Section 1231 gain. Now, I have more videos covering how to calculate the 1231 gains, but in short here, when we have assets that are used in a trade or business and depreciated, if you hold the asset for more than a year and sell it, you get Section 1231 treatment. Now, Section 1231 treatment is ideal because if you have a gain, that's a 1231 gain, it's taxed as a capital gain generally. But if you have a losses, you get ordinary loss treatment. So 1231 is kind of the best of both worlds. If you actually make money and you have a gain, you're looking at capital treatment. If you have a loss, you get ordinary loss treatment, which is the best kind of loss to get because it offsets ordinary income and there's generally no limitations on like things like the $3,000 capital loss limitation. So I'll put more links to videos below if you want to learn more about the 1231 items. But once the 4797 is done here, the numbers end up in two places, right? So the ordinary gain flows through to line 4. So there's the net gain or loss from 4797. So that just gets included in ordinary income. But the 1231 component, that extra $200, that's reported on line 9. So it's a separately stated item, line 9, net Section 1231 gain from the form 4797, $200. All right. Okay, so that one is entered. Now let's have a look. Let's go back to the financial statement. So we've got the fixed assets are disposed of. Interest income, so that is also a separately stated item. So that goes on the K1. So interest income separately stated on the K1, line 4, $24. And then the charitable contributions, also a separately stated item. Right, so charitable contributions separately stated on line 12A. And we've attached a statement 9 indicating that a 60% charitable contribution. So what does that mean? Let me go to the supporting statements here. So statement 9, cash contribution 60%. So they made a $1,200 donation to a public charity, so a 501c3 organization. Generally, when those flow through to your personal return, you can take the charitable deduction up to 60% of your AGI. That's important because if you donated to, let's say, a private foundation, there's usually a 30% limitation. That's if it's cash. If it was property, it would be even lower, maybe even 20. So that's why it's important that they have more details on, okay, that was a charitable contribution, but was it cash or other property, and what kind of charity actually received the donation? So those are the three separately stated items: the interest, the 1231 income, and then the charitable contribution. So now if we have a look at the ordinary income or loss items, that's everything else up here. So the food and beverage sales, $1,078,000, cost of goods sold, $856,000, and then the various expenses, right? Employee wages, officer wages. So those items are all just entered here on page 1. So we've got the gross receipts, cost of goods sold, and we've attached an 1125A. $856,600, and then all the other various expenses. So officer compensation is separately stated on line 7, and then it's also reported on 1125E. So we do include an 1125E to report the compensation paid to Jane Doe. There's our $18,500 figure. And then all the other expenses as well. So salaries and wages, repairs and maintenance. So the line 1 ordinary business income or loss is the $29,572 figure. And then this item flows through to Schedule K1, line 1. So if we look at the K1 here, line 1, ordinary business income or loss, this flows through from page 1, line 22. All right, so now once those profit and loss figures are entered, what do we do with the balance sheet? So the balance sheet, when you're filing a final return, the balance sheet at the end of the year is going to be zeros, right? Everything has to be zeroed out. If there's something left over, then it means the company's not actually closed down, right? It hasn't completely liquidated, it hasn't removed all of its assets, its liabilities, and made any distributions to the shareholders. So everything has got to be zeroed out here. So if we look at our balance sheet, this is effectively our balance sheet right before we actually made those distributions to cover the debts and pay the shareholders whatever's left over. So we can see we've got a bunch of cash left over up here. And so I've put this reconciliation on the right-hand side to show how everything was paid out. So the total cash available before we go through the debts and the equity is $149,509. So we're going to use that cash to pay off the AP and the credit cards, which means we're going to be left with $107,805. This is the amount of cash that can be distributed to the shareholders, because at this point, all the expenses have been paid, all the debts have been paid, and now the shareholders get a distribution, a liquidating distribution of whatever's left on the asset side. In this case, it's all just cash. So when they get paid out the $107,805, it really comprises two components, right? So it's a distribution from earnings and profits of the company, which as corporations, it's non-taxable, right? Because everything is flow through. But I think it helps to see the character here and see how all this zeroes out. So the company had $4,209 of retained earnings at the start of the year. It had net income for the period, $28,596. So when you total up these two, we've got $32,805 of earnings and profits leading up into the entity closing. And so we can see that illustrated as well in the M2 reconciliation. So in the M2, we've got $4,209. We add our ordinary income. We have our other additions for the 1231 gains and the interests. And then we have a reduction for the charitable contributions, which leaves us with $32,805. So when all this cash is distributed, we've got a reduction to retained earnings, $32,805, and then the excess, right? So if you take this 32 out of the 107, the excess is going to be $75,000, which is the return of principal. So the amount of principal that they contributed in the prior year was $1,000 for the capital stock, and then APIC, additional paid in capital, is $74,000. So when you look at the reconciliation at the end of the year, these should often just zero out. And so that's what we can see as illustrated here, is everything kind of cleanly zeroes out. And so the shareholders' basis is also going to be zero at the end of the period. And so we'll look at those worksheets as well. So if we take a closer look at the K1, so the K1, the last item on the K1 here, line 16D, distributions, $107,805, right? So that's the cash that was being distributed out here, right? The remaining cash after all the debts were paid. So it's reported on K1, line 16D. And then that amount, again, it comprises the reduction to retained earnings, which is shown here, $32,805. So if one question I get is why is it just this amount? Why don't we put the full $107,000? Well, because you can't have a negative AAA account, right? So, and it also wouldn't make sense, right? We don't have enough earnings to actually distribute $107,000 of earnings, right? That's why there is the return of principal component. So the distributions here would effectively be whatever amount you need to zero out the AAA account, and then the rest of it would be the return of principal. At least that's the way the math should be working. At least if it's an example that's relatively straightforward like this one. So on the shareholder K1s, they're going to get the full 107,000 is being recorded as a distribution, but as far as the M2 reconciliation, we're only reducing it by the 32,805 to get a zero balance at the end of the year. So we've got zero accumulated adjustments out at the end of the year, and zero balances on the asset, liability, and equity section in the Schedule L for the balance sheet. All right, so after that is done, then we can start looking at how the K1s flow through. So the Schedule K1, so in this example, we've got two shareholders, John Smith, Jane Doe. John's a 75% shareholder. Jane is a 25% shareholder. And so the K1 is also being marked as a final. And the K1 also shows January 1 through October 31st. So it's not a full calendar year 2023. So with S corporations, everything has to be allocated pro rata based on your ownership percentage, right? So it's not like a partnership where we can have special allocations. So John is going to get 75% of all of the income and allocable items on Schedule K. So 75% of $29,572 is allocated to John, and that's what he sees up here, $22,179. So you do the same for each item. He gets 75% of the total ordinary income, 75% of the interest, 75% of the 1231 gains, and then the same proportion for the charitable contributions on line 12A. Now the basis distributions also 75%, so he's allocated $80,853 of cash. So this is the actual amount of cash that John should receive as a liquidating distribution. So that's $80,853 that he gets cash transferred into his bank account. Okay, so we've got QBI information. So the restaurant does qualify as a qualified business for 199 Cap A, right? The qualified business income deduction. It is not a specified service trade or business, and so we've got, again, John's allocation of the ordinary income or loss, the 1231 gains, and then his allocable share of the W-2 wages for the period, and so he can use this to calculate his Section 199A deduction on his return. Now, the last item, which is important, is always the basis worksheet. So shareholder basis, oftentimes the S corporations are calculating this for the shareholders just to kind of track it. But ultimately, the shareholder is the one responsible for tracking their own basis and reporting all this on a 7203. So 7203 is a recently added form where shareholders track their basis and they attach it to their 1040. And so John, when he does his 1040, he can use the K1s and he can use this information as well to complete his 7203. So his basis at the beginning of the year, $59,506. We can see that carry forward from the prior year. If I go back to the 2022 K1 for John here, if we scroll down to his basis worksheet for 2022, we can see that at the start of the year, basis was zero because it was a brand new entity in 2022. But his end of the year shareholder basis at the end of 2022 was $59,406. And so that basis figure has been rolled forward to this year as well. So we've got his basis at the start of the year, his increases, right? So we've got the positive amounts of income, ordinary income, interest, 1231 gains. We've got the distributions reported here as a reduction, so $80,853 in cash distributed to him. So his basis is now reduced to $900, and then he receives a $900 allocation of charitable deductions. So this reduces his basis totally to zero. All right. And so the same process would happen for Jane's K1 as well. So I won't go through her K1 because it's the same information. It's just a different allocation because she's a 25% shareholder. But same principle applies, right? Final K1 because the entity's closed, and then all of her information, and then her allocation of those items. Now, the last thing to touch on here is the Schedule K2. So there's no foreign activity in this S corporation, right? So it's all local sales. They don't have any non-U.S. partners or anything, but because the information on K2 is helpful in completing the Form 1116, the foreign tax credit, we often see this prepared just so the shareholder can get a sense of the gross income item. So the only thing we are doing here is part 2, right? So we're doing a part 2 for gross income and then expenses. And so we'll go through this really quickly here. So gross income, sales, $221,918. So sales, when we talk about gross income under the tax code, it's actually defined as gross revenue net of cost of goods sold. So this sales figure, $221,918, that's actually the gross profit up here, right? So $221,918 gross profit. So it's the total sales minus cost of goods sold. And so you don't actually, so in other words, you don't actually report the full 1.078 million as the sales. You can just do it net of cost of goods sold. So it's U.S. source income. U.S. of A is listed as the country of source. We've separately stated the interest income down there. We've separately stated the Section 1231 gain. There's the $200 1231 gain. And we've also separately stated the ordinary portion on the sale of the assets. Now, you could actually, if you didn't want to separately state this, you could put this up here into the sales figure. And I suppose the logic there would be, well, if we look up here, our gross profit, I still like separately stating it, but you could argue that, well, the total income or loss up here, the sales figure, it includes that net gain or loss from the sale of the kitchen equipment. But I think it does make better sense to have it separately stated. So the gross profit figure here, the $221,918, sales less the cost of goods sold, is what's reported on the K2. So, yeah, I would recommend doing it that way still. So, so we've got the net profit up there, the net gross profit, that is, separately stated item from the sale of the kitchen equipment. So total gross income down here, $238,042. And then we go on to the expenses in part 2. So expenses allocable to sales item. These are all the expenses other than what has to be separately stated. So we've got a separately stated amount for charitable contributions. That's on line 38. Again, it's U.S. source. You can't allocate it in any other manner. As you can see, it's all grayed out here. The other interest expense reported on line 40. Right, so we had $340 of interest expense right here. So that's been separately stated as well on line 40. And so everything else, it just gets lumped into the 207,906 figure, unless, of course, it was separately stated here, right? So in our case, we didn't have any depreciation this year. If you had depreciation, those would be separately stated items there as well, but in our case, didn't apply. So when everything is said and done here, when we look at the net income or loss, you can see there's the 28,596 figure. So that's our net income or loss per books that we see not only here, 28,596, but it's also reported on the Schedule M1, $28,596. Okay, so let's go back to K2. And so part 3, again, we didn't complete that. We're just doing parts 1 and 2 in case that these shareholders had to do an 1116 and needed more information on their gross income and expenses. All right, so I think that covers everything I wanted to address. Let's see, we've gone over the 1231. Yeah, okay, so I think we've covered everything. I hope that was helpful. Any questions, obviously, feel free to leave a comment below. I will put links below for all the videos that kind of have similar references to items that we talked about. So 4797, 1231 gains, depreciation recapture, all that good stuff. So go take a look at those other videos as well. As always, appreciate you watching. Hopefully it was helpful, and I look forward to seeing you again on the next one. Thanks.